Today let's talk about safe and assured investments. The investments you don't want to take any risk at all. When I say that, what comes to your mind? Fixed deposit, right? FDs. But the thing is, we are financially literate people. We have to know, is FD the only answer? Maybe it is, maybe it's not. But let's have a look at another asset class which is parallel to FDs, and that is bonds. First, let's understand what is a bond. Buying a bond basically means that you have lent the money to a borrower or an issuer, and the issuer pays you interest every year till the end of the maturity period, and you will receive your principal amount at the end of the maturity period. So for example, let's take an example of SBI, State Bank of India. So you buy an SBI bond which has face value 10,000 rupees, coupon rate 9% and maturity of 10 years. So this means that you have 10,000 rupees, you will get an interest of 900 per year which will be credited to your bank account, and at the end of 10 years you will get your 10,000 rupees face value, which is the basically borrowed amount, back to your bank account. So this is how the bonds work. So now let's compare the two. First, interest rates. So if you buy an FD right now, you will get anywhere from 7 to 7.5%. But if you buy a SBI AAA bond, you will get around 8.5% CAGR. That's about 1% more, which is a lot. Second, capital gains. Now bonds give you interest each year, right? But you can make a capital gain if you buy at the right time. Confused? Let's explain this with an example. Let's take a hypothetical situation in which the current interest rates are 8%. If you invest in a bank for FDs, they'll give you about 8%. At that time, State Bank of India would have released 8% bonds on it, AAA bonds, which give you 8% interest. So now after about 6 months or 7 months, RBI, the Reserve Bank of India, reduces the interest rates to 7.5%. Now if you invest in FDs, you will get 7.5%. But the bond is still there, which is giving 8%. So this means that bond is giving you more interest and is much more valuable. So the price changes from about 10,000, approximately 10,000 face value, the price will increase to more than 10,000, maybe 10,500, 10,600, approximately that range. So if you sell at that point, you will get a capital gain of 500-600, which is again a lot. If you see that we're investing in a asset class which has no risk at all, almost no risk at all. Third, ease of transactions. Now buying an FD is super simple. You just go to your bank or maybe apply online. But to buy a bond, you'll have to go through the exact same procedure of buying a stock. So you'll have to have a demat account and trade through the exchange, which means NSE or BSE. So both are really simple, but I'd say FD is a little more simpler. That's it. Fourth, lock-in period. Now FDs have a lock-in period. You have to choose whether you want a 3-month FD, 6-month FD, 1-year FD or so on. And if you want your money before the time, before the maturity date, you'll have to pay a small penalty on it. In bonds, there's nothing like this. You can buy it anytime and sell it anytime, just like any other stock in the exchange. Fifth, cost of transaction. Now, there are no cost of transaction in FDs. You can just go to your bank, apply a small form and that's it. But in bonds, you have to pay small brokerage. Why? Because you're trading through a broker. You're trading in the exchange. So you'll have to pay a small brokerage to buy a bond. Sixth, regular payments. Now you will have to decide if this is an advantage to you or disadvantage. In bonds, you'll get a regular payment. Means the interest which will be accrued to you every year will be credited to your bank regularly. Unlike FDs, the full amount will be given to you lump sum at the end of the maturity period. So for example, if you want a regular payment each year, then go for bonds. Seventh, risk. Now if you buy a bond, there is a very minor probability that the issuer goes bankrupt. In that case, you won't be able to redeem back your bond. But it's the same case with fixed deposits too. If you get a FD done from a bank and that bank goes bankrupt, you won't be able to claim the full amount. So overall, what we can say is that these two are really very safe, and you don't have to worry about the risk part. So looking at all the differences, we see that FDs is not bad at all, but bonds seem to be a better option. We generally go for FDs because we don't have much knowledge on bonds. But I want you to go for the best option and not just settle for the one you know.